The central bank is arguably the most crucial financial institution in any country, acting as the apex monetary authority. Its role is akin to the conductor of an orchestra. It doesn't play every instrument, but it sets the tempo, ensures harmony, and makes sure the entire performance, the economy, stays on track. Here's a breakdown of the central bank's primary roles in a country's economy. 1. Monetary policy implementation, the conductor's baton. This is the central bank's most visible and impactful role. It involves managing the money supply and credit conditions in the economy to achieve macroeconomic goals like price stability, controlling inflation. This is often the primary mandate. The central bank aims to keep inflation, the general increase in prices, low and stable, typically around 2 to 3%. High inflation erodes purchasing power, creates uncertainty, and can destabilize the economy. How it does it? By adjusting interest rates, like the repo rate in India or the federal funds rate in the US. When interest rates rise, borrowing becomes more expensive, discouraging spending and investment, thus cooling down an overheating economy and curbing inflation. Conversely, lowering interest rates encourages borrowing and spending to stimulate a sluggish economy. Open market operations, OMOs. Buying or selling government securities in the open market. Buying securities injects money into the banking system, increasing liquidity and encouraging lending. Selling securities does the opposite, withdrawing money from circulation. Reserve requirements. The percentage of deposits that commercial banks must hold in reserve. Changing this affects how much money banks have available to lend. Economic growth. By influencing interest rates and money supply, the central bank aims to create an environment conducive to investment, job creation, and sustainable economic growth. Full employment. While not always a direct target, stable prices and healthy growth generally contribute to lower unemployment. 2. Banker to the government. The government's financial manager. The central bank acts as the government's bank. It manages government accounts, holds the government's deposits, and makes payments on its behalf. Acts as a financial agent, manages public debt, issues government bonds, and helps the government raise funds. Provides financial advice. Offers expert economic advice to the government on fiscal policy and financial matters. 3. Banker to commercial banks. The bank's bank and supervisor. Commercial banks like SBI, HDFC, ICICI, etc. in India rely on the central bank for various functions. Custodian of cash reserves. Commercial banks are required to keep a portion of their deposits with the central bank. Cash reserve ratio (CRR). Lender of last resort. In times of financial crisis or liquidity shortages, the central bank provides emergency loans to commercial banks. This prevents bank runs and a systemic collapse of the financial system, acting as a crucial safety net. Clearing house. Facilitates the clearing and settlement of interbank transactions, e.g., when you write a check to someone who banks with a different bank. Supervision and regulation. Oversees and regulates commercial banks to ensure their stability, compliance with rules, and protection of depositors' interests. This involves setting prudential norms, conducting inspections, and licensing banks. 4. Issuer of currency. The sole printer of money. The central bank has the sole authority to issue a country's currency, banknotes and coins. This ensures uniformity, a single consistent currency system across the nation. Public confidence, trust in the value and authenticity of the currency. Control over money supply. The central bank can control the amount of physical cash in circulation, which is a component of the broader money supply. 5. Custodian of foreign exchange reserves, managing international trade and stability. The central bank manages the country's foreign currency reserves, like US dollars, euros, yen, gold. This is important for exchange rate stability, intervening in foreign exchange markets to manage the value of the domestic currency relative to other currencies, helping to stabilize international trade and payments. facilitating international transactions, providing foreign currency to meet the needs of international trade and capital flows, dealing with balance of payments issues, using reserves to cover deficits in the balance of payments. In summary, the central bank is a critical pillar of a modern economy. It aims to maintain monetary and financial stability, which are essential prerequisites for sustained economic growth and prosperity. By controlling the money supply, setting interest rates, regulating banks, and managing currency, it acts as the steward of the nation's financial health.